How does fixed income allocation work? Have you ever wondered how fixed income allocation can shape your investment strategy? Let's break it down in a straightforward way. Fixed income allocation is all about distributing part of your investment portfolio into fixed income assets. These are financial instruments that provide regular and predictable income, mainly through interest payments. Common examples include bonds, certificates of deposit, money market funds, and other debt securities. The main goal of fixed income allocation is to generate steady income while reducing overall portfolio risk. Compared to stocks, fixed income assets are typically less volatile, making them appealing for conservative investors or those looking for income stability. When you invest in fixed income, you are essentially lending money to an issuer, like a corporation or government, in exchange for periodic interest payments and the return of your principal at maturity. Interest rates, often referred to as coupon rates, are fixed, which means you can count on a predictable cash flow. This reliability is why many people consider fixed income investments when planning their finances. Banks and credit unions play a significant role in this area by offering various fixed income products. They manage their own investment portfolios with fixed income components as well. For them, fixed income allocation serves several purposes. First, it helps with risk management. Fixed income assets usually have lower volatility than stocks, which help stabilize returns and protect capital. This balance is essential for banks and credit unions as they aim to provide secure services to their customers. Second, fixed income investments generate reliable interest income. This income supports operational needs or member dividends. For credit unions, this can include investments in mortgage-related securities or fixed-rate member business loans. Third, liquidity and capital preservation are important. Products like certificates of deposit and money market funds offer liquidity and principal protection, which are vital for meeting short-term obligations and regulatory requirements. Fourth, diversification is key. Including fixed income in a portfolio reduces concentration risk by spreading investments across different asset classes. For instance, credit unions monitor concentration risk in real estate loans and mortgage-backed securities to avoid overexposure. Now, let's look at some practical fixed income products offered by banks and credit unions. Certificates of deposit are time deposits with a fixed interest rate and maturity date, often insured by the Federal Deposit Insurance Corporation or the National Credit Union Administration, up to $250,000. This provides principal protection. Bonds are another option. These are debt securities issued by governments, municipalities, or corporations that pay fixed interest over a set period. Money market funds are mutual funds that invest in low-risk, short-term debt instruments, offering liquidity and safety. Fixed annuities are also available. These are insurance contracts that guarantee a fixed rate of return over a specified period. The allocation to fixed income within a portfolio depends on several factors, including investment goals, risk tolerance, and time horizon. For example, a conservative investor or a bank's liquidity portfolio might have a higher fixed income allocation to ensure steady income and capital preservation. On the other hand, a more growth-oriented investor might choose to allocate less to fixed income. In essence, fixed income allocation works by investing a portion of assets into debt instruments that provide regular income and lower risk. Banks and credit unions utilize fixed income allocation to serve their members with secure, income-generating products while managing their financial stability through diversification, risk control, and liquidity management.